Okay, so you want to own a football club, buy the club, sign some stars, win some trophies, watch the value climb. That's the pitch every new owner walks in with. Here's the problem. Most football clubs lose money every single season, even the famous ones. And the ones that don't are usually breaking even by accident, not by design. Here's the reframe, and it's the single most important thing to understand before you spend a dollar. A football club isn't really built to make money. It's built to win, and profit is whatever happens to be left over after winning, which, for almost every club on earth, is nothing, or a negative number. Economists who study this industry have a name for it. Most sports team owners aren't profit maximizers. They're win maximizers. A normal company that loses money every year eventually cuts costs until it doesn't. A football club that starts cutting costs starts losing matches, and a club that starts losing matches loses fans, sponsors, and relevance, so owners keep spending well past the point of rational profit, because the alternative is worse than losing money. That's not a bug in how this business runs. That's the actual business model. Once you see it that way, the entire financial structure of the sport starts making a lot more sense. Let's start with the sheer scale of what you're buying into, because the gap between the top and the bottom of this industry is bigger than almost any other business you could name. The top 20 highest revenue clubs in the world pulled in a combined 12.4 billion euros last year, growing 11% in a single season. Real Madrid alone generated close to 1.2 billion euros. Their commercial revenue by itself, just sponsorships and merchandise, nothing from tickets or broadcast deals, would rank them in the top 10 clubs in the world on its own. That's the very top of this business. Now look at the tier just below the elite European leagues. An entire season of England's second division, the Championship, 24 clubs combined, generated under £1 billion total. One club at the top of this sport can out-earn an entire division below it. You're not entering one industry when you buy a football club. You're entering one of roughly 5 completely different industries that all happen to share a rulebook. And which tier you land in determines almost everything else about the numbers that follow. Here's the part that catches almost every new owner off guard. And it's not the price of the club itself. It's the payroll. Even within that top 20, the revenue mix looks completely different depending on where you sit. For the top 10 clubs in the world, commercial revenue, sponsorships, and merchandise makes up the largest single share of income, around 48% of the total. For clubs ranked 11 through 20, broadcast money is the dominant layer instead at 47%. That's not a small distinction. It means the elite clubs have built a revenue engine that doesn't depend much on how any single season goes, while the clubs just below them are still substantially at the mercy of league broadcast deals negotiated collectively, over which any single club has almost no control. You can be a genuinely well-run, competitively successful club and still be structurally more exposed to a bad broadcast renewal than a rival with a bigger global shirt sponsorship deal. Across the Premier League, the average club spends 65% of its entire revenue on wages alone, not 65% of profit. 65% of the entire top-line revenue disappears into player and staff salaries before you've paid for a single blade of grass, a stadium light bulb, or a physiotherapist. And that number is actually the healthy end of the spectrum. Plenty of clubs run wage bills well above what their revenue can rationally support, betting that the success on the pitch will eventually catch the balance sheet up. On top of wages, there's a cost most fans never think about at all: agent fees. Premier League clubs paid out £460 million to agents and intermediaries in a single recent year, a 13% jump from the year before. One club alone, Chelsea, paid their agents more than £65 million in that period, nearly a quarter of the entire league's total, from a single team, and their third consecutive year topping that particular list. It's not just the elite clubs feeling this either. When Sunderland won promotion to the Premier League through the playoffs, their agent spending jumped from £2.2 million in the Championship to £10.6 million in the top flight in a single season, a nearly 5-fold increase, just from the higher stakes and higher fees that come with playing at a higher level. Moving up a tier doesn't just raise your revenue ceiling. It raises the cost of doing business at every level simultaneously, whether you're ready for it or not. And then there's the accounting trick sitting underneath almost every transfer headline you've ever read. And once you understand it, you'll never read a transfer fee the same way again. When a club signs a player for, say, £100 million on a 5-year contract, that fee doesn't hit the books all at once. It gets spread evenly across the length of the deal, £20 million a year, in accounting terms, whether the player is brilliant or hurt on the bench the entire time. This is called amortization, And it means a club's true financial exposure to a single transfer often isn't visible in any single year's accounts. It also means something sneakier. If you sell that same player 2 years later, once his book value has depreciated down to 60 million, and someone pays you 100 million for him, your books show a 40 million pound profit on the sale, even though you originally spent 100 million to get him in the first place. This isn't creative bookkeeping in the illegal sense. It's just how the accounting works. But it means the regulators trying to police clubs' spending are working with numbers that don't remotely resemble the actual cash moving in and out of the building. Which brings us to the part of this business that genuinely doesn't exist anywhere else in normal commerce. The referee is also a competitor. The Premier League enforces something called profitability and sustainability rules, and UEFA runs a parallel version of the same idea, both designed to stop clubs from simply outspending their revenue into oblivion. On paper, that sounds sensible. In practice, it means the very league a club competes in also polices how much that club is allowed to lose while trying to compete against those same rivals for the same trophies. Manchester City is currently facing 115 separate charges from the Premier League, later clarified to be closer to 130 distinct alleged rule breaches once you count every individual season and rule combination, covering financial reporting from 2009 through 2018, centered on accusations that ownership funding from Abu Dhabi was disguised as ordinary sponsorship revenue from entities like Etihad Airways and a major regional bank, rather than reported as what critics allege it actually was, the owner effectively topping up the books through commercial partners connected to him. City deny all wrongdoing and have separately gone to court to challenge whether the league's related party transaction rules are even lawful in the first place. The hearing concluded in 2025 and, as of this taping, the verdict still hasn't landed, a case some sports lawyers have taken to calling the trial of the century, unresolved for more than 2 years and counting. Whatever the eventual outcome, the case itself tells you something important about this entire industry. The financial rules of the sport are contested at the very top by clubs with essentially unlimited legal budgets, and even they can't get a clean, timely answer on what's actually allowed. If the regulatory system can't resolve a dispute involving the reigning champions within 2 years, it's a reasonable bet the same system isn't offering much real protection to a mid-table club trying to figure out how much it's safe to spend this summer. So how does a club actually bring in revenue to cover all of this? There are 3 layers, and they've shifted dramatically in relative importance over the last decade. The oldest layer is matchday revenue: tickets, hospitality boxes, concessions, the stuff fans directly associate with going to a game. Across the top 20 clubs in the world, that added up to 2.4 billion euros last year. It's real money, but it's also the smallest of the 3 layers, and it's capped by something no amount of ambition can change: how many seats physically exist in the stadium. The second layer is broadcast revenue, the money leagues collect from selling the rights to televise matches, then distribute to clubs. That's a much bigger number, 4.7 billion euros across the top 20 clubs, and it's also the layer most exposed to forces completely outside any single club's control. If the value of a broadcast contract drops at renewal, every club sharing that pool takes the hit simultaneously, regardless of how well any individual team performed that season. The third layer, and now the largest one, is commercial revenue: shirt sponsorships, stadium naming rights, global partnership deals, merchandise. That hit 5.3 billion euros last year across the top 20 clubs, the first time any single revenue category in this sport has crossed the 5 billion mark. This is also the layer where the biggest clubs pull furthest ahead of everyone else, because commercial revenue scales with global brand recognition in a way ticket sales and even broadcast money simply can't match. A club with hundreds of millions of fans worldwide can sell a shirt sponsorship for a number a mid-table club could never touch, no matter how well that mid-table club performs on the pitch that season. Stack those 3 layers together and you can see the real shape of the business. Matchday revenue is stable but capped, broadcast revenue is large but shared and volatile, and commercial revenue is where superstar brands separate permanently from everyone else. Which means the clubs already at the top have a structural advantage that good management alone can't close, and the clubs in the middle are stuck fighting over the layer of the business that's hardest to control. Now let's talk about what happens when the wage bill outruns those 3 revenue layers for too long, because this isn't a rare, dramatic exception in football. It's a routine, recurring event. Start at the very top, because even elite clubs aren't immune. Chelsea posted a pre-tax loss of £262 million for their recent season, the largest single-season loss in Premier League history, from one of the most famous clubs in the world. To get back into compliance with financial regulations, the club had to offload nearly £300 million worth of players in a single window, essentially selling off assets under pressure to satisfy accountants rather than to strengthen the squad. That's a club with over £1 billion in ownership backing, still forced into a fire sale by the math. Now go down the ladder, because further down, the same dynamic doesn't just produce a bad headline. It kills clubs outright. Go back through recent English football history and you'll find the same story on repeat, at every level of the pyramid. A club spends beyond what its revenue tier can support, chasing promotion or trying to avoid relegation, and eventually, the debt comes due faster than the wins do. Since the early 1990s, roughly 20 English clubs have been hit with points deductions, specifically for entering administration, a list that reads like a tour through the entire league pyramid, rather than one unlucky corner of it. Bury Football Club, one of England's oldest clubs, was liquidated and expelled from the league entirely. The first club kicked out of the English football pyramid in almost 30 years. Derby County entered administration, owing creditors so much that the club was losing over £1 million a month, and on top of the automatic points penalty for entering administration, was hit with an additional, separate deduction of 21 more points for historical accounting breaches, tied to how it had valued its own players on the books, the same amortization mechanic we just walked through, allegedly pushed past what auditors considered reasonable. Between the two penalties, the club effectively lost the season before a ball was kicked. Parma, a club that had won European trophies within living memory, was declared bankrupt by an Italian court, with debts estimated above €200 million. And this isn't ancient history. A storied English club filed for administration just last October, hit with an immediate 12-point penalty, after failing to pay its own players on time in 5 of the previous 7 months, with its own owner sitting as the club's single biggest creditor. The pattern isn't confined to one country, one league tier, or one decade. It's structural to how the sport finances itself, and it's still happening right now, in real time, somewhere in the pyramid, most seasons. Here's the mechanism underneath all of these stories, and it's the same one every time, whether it plays out in the Premier League or 3 divisions below it. A club spends aggressively based on where it hopes to finish, not where its actual revenue tier supports. For a season or two, that bet can look brilliant. Promotion, a cup run, a signature signing that raises the whole club's profile and pulls in new sponsors. But the wage bill doesn't shrink just because results go the other way the following season. Contracts are multi-year commitments, signed during the good times, and they don't get cheaper the moment the team gets relegated, or the sponsors lose interest and move on. A relegated club can lose a huge share of its broadcast revenue overnight, while still owing 3 more years of wages at Premier League rates to half its squad. The gap between committed spending and actual revenue doesn't close gradually either. It sits there, compounding month after month, until either new investment arrives to cover it or the club runs out of runway entirely. And by the time an owner realizes the runway is gone, the points penalty and the administrators are usually only a phone call away. So let's actually run the numbers on what ownership looks like in each direction. In the optimistic scenario, you're one of the handful of clubs operating at the very top of the commercial layer, global brand recognition, a self-sustaining sponsorship engine, broadcast revenue from consistent participation in the most valuable competitions year after year, revenue in the hundreds of millions to over $1 billion, a wage bill that a healthy commercial and broadcast income can actually support without straining, and enough financial cushion that a single bad transfer or an injury-hit season doesn't threaten the club's existence. This is the version of football ownership that gets written about in glowing terms, the one every prospective buyer pictures when they first fall in love with the idea. And it's genuinely available, but only to a tiny handful of clubs that already had a massive head start in brand recognition and history before you ever showed up with a checkbook. You can't outspend your way into this tier in a single transfer window. It takes decades of accumulated global reach that no amount of first-year investment can manufacture on its own. In the realistic scenario, you own a mid-table or lower league club competing for promotion or fighting off relegation, spending close to or beyond what your revenue tier can rationally support, because that's what competing requires. Your wage bill sits near or above that 65% average. Agent fees and transfer amortization quietly eat into whatever margin might otherwise exist, and you're structurally dependent on results that are, by definition, not guaranteed. Someone finishes bottom of every division every single season. One bad year doesn't just cost you on the pitch. It can trigger the exact chain reaction that's ended clubs with far longer histories than whatever you're building: mounting debt, an ownership crisis, administration, and a points penalty that turns a bad season into an existential one. The gap between those two outcomes isn't really about ambition or spending discipline. It's about which revenue tier you were already sitting in before kickoff. So if you're picturing yourself buying a football club, here's the actual lesson underneath the trophy photos. You're not really buying a business optimized to generate returns. You're buying a seat in a competition where nearly every participant is structurally incentivized to spend past what's rational, refereed by rules even the richest clubs in the world can't get a straight answer on. In an industry where the gap between the top and the bottom is wider than almost anywhere else in commerce, the wins are real. The trophies are real. For most owners, the profit isn't. And the ones who forget that are the ones you'll find in the club history section marked administration.